Office records. Broker-dealers must ensure that the firm makes and keeps current as to each office certain books and records that reflect the activities of that office. So in the office, now remember, contact person records to know what the records are in that office are kept for 6 years. What are the records kept in the office? Blotters, order tickets, customer account records, customer complaints, records with respect to associated persons, records evidencing compliance with SRO rules regarding communications with the public, records of persons who can explain the information in the broker-dealer's records, records of each principal responsible for establishing record-keeping compliance procedures. So all that's related to the office. So remember, records are kept readily accessible for 2 years. Records in that office kept 2 years, most recent 2-year period of time. Broker-dealers must ensure that they have originals of all communications with the public, must be kept for 3 years, 2 years, readily accessible. So that would include the communication and approval thereof. So 3.2. Let's do a summary of all the 3.2 rules. So we have order tickets kept for 3 years, 2 years, readily accessible. Compensation records, associated person, compensation records, also 3.2. You know what that means. 2 years readily accessible. Complaint records, this is all under SEC Rule 17A-3. But remember FINRA. FINRA says how long? 4. They can't be the same, so FINRA rule is different. Communication supervision records. And communication records. So they really is 2 separate rules as far as these things go, but they're both 3.2. They're both 3.2. So that gives you a chart that has all of the rules that have the 3 years, 2 years readily accessible rule. Organizational documents of the firm. So things like a firm's partnership articles or articles of incorporation, corporate charter, minute books, stock certificate books, forms BD and BDW must be kept for the life of the firm. So this is a new rule. Organizational documents must be kept for the life of the firm and of any successor enterprise. Special reports. Broker-dealers must ensure that the firm has each report that a securities regulatory authority has requested or required a broker-dealer to make and furnish to it, and each securities regulatory authority examination report. Special reports are kept by the firm for 3 years from the date of the report. Compliance, supervisory, and procedure manuals are kept for 3 years after the termination of the use of the manual. So compliance, supervision, and procedure manuals. Because we know that supervision rules must be in writing. So all of these rules are kept for 3 years after termination of the use of the manual. Exception reports. Broker-dealers must ensure that the firm has all reports produced to review for unusual activity in customers' accounts. So exception reports must be kept for the shortest period of time. They're the exception. 18 months is all. Exception reports are kept for 18 months. We already learned under SEC 17A-4 that organizational records related to the firm are kept for how long? Life of the firm, of course, and that's also true under 17A-4. Same rule. How long are blotters kept for? Articles of original entry? Customer account records? 6 years. So really we've got most of the time 3-2 as the rule. There's some 6-2s also. There's the lifetime for the organizational documents. The exception reports are only 18 months. That basically summarizes most of those. There's a lot of dates, so practice some flashcards. The thing with law, which this test is a heck of a lot of it, is you either know it or you don't. So practice it, make sure you know it, and this test will be easy for you. NASD Rule 2830. NASD Rule 2830 has to do with investment company securities. There's also a FINRA rule, which is FINRA Rule 2320, which really comes up later on in the course, but they're very similar rules. It really has to do with how we can pay people compensation. The NASD rule has to do with mutual funds, basically, and then the FINRA rule has to do with variable products. And someday the NASD rule will be updated and it will be a FINRA rule as well, but for now. So some definitions under NASD Rule 2830. Affiliated member shall mean a member which directly or indirectly controls, is controlled by, or is under common control with a non-member company. Compensation shall mean cash compensation and non-cash compensation. Cash compensation shall mean a discount, concession, fee, service fee, commission, asset-based sales charge, loan, override, or cash employee benefit received in connection with the sale and distribution of investment company securities. Non-cash compensation is any form of compensation received in connection with the sale and distribution of investment company securities that is not cash compensation, thus the title non-cash compensation, including but not limited to merchandise, gifts, prizes, travel expenses, meals, and lodging. So that's really what this rule is going to be getting at, is how can this happen? Can this happen, and how can it happen legally? Can there be sales contests? It's not called the sales contest rule, but that's really what it's going to be getting at as far as test questions on your exam. So cash compensation and non-cash compensation. How can we, what is considered non-cash compensation? When is it allowable? An offerer, under this definition, shall mean an investment company, an advisor to an investment company, a fund administrator, an underwriter, and any affiliated person of such entity. So if you think about this for a second, what it's trying to get at is, here you are as a registered rep, let's say you have your Series 6, let's say you work for a broker-dealer, and you can sell 12 different mutual fund companies. That's what you have available to offer to your clients. So the mutual fund company A really wants you to sell their mutual funds. So what can they give you to entice you to do that? What is okay? What is not okay? What can the offerer incentivize you with, for lack of a better way of saying it, or can they? How can your broker-dealer encourage you to sell investment company securities within the realm of this rule? Because of course they want to follow the rules of the NASD, of FINRA. So an offerer is just really a fancy way of saying the investment company or investment advisor. Brokerage commissions are not limited under this rule to commissions on agency transactions, but shall also include underwriting discounts or concessions and fees paid to members in connection with tender offers. There's other definitions within this rule. I'm going to just tell you to read them. I'm not going to read them all to you. That's really boring. The idea that there is a sales charge that you make when you make a recommendation to sell or to purchase a mutual fund share, you get a sales charge. Whether or not the sales charge is front-loaded, back-end loaded, or comes out of a 12B1 fee, we don't care. 12B1 fees really are not used under NASD or FINRA rules. 12B1 fees we call asset-based sales charges, because that is in fact what they are. Those would all be within the word or the definition of sales charges. A service fee is a fee charged by a mutual fund to an account holder for account maintenance, managing the account. Some funds have service fees and some do not. Service fees, something like $20 a year out of your account, $30 a year, whatever it is. Sometimes the higher your account gets, it's kind of like a fee at the bank, a service fee, where if you have $5,000, they won't charge you the service fee. So I'm not going to read you all the definitions. Make sure you read them all. NASD Rule 2830 has to do with the maximum sales charges that mutual funds can charge. Now, we already learned what this is, in a simplistic form, of course, so we'll review what we already know. So under NASD rules, which are now, of course, FINRA rules, but this is what we're talking about right now, NASD Rule 2830, the maximum sales charge that may be charged is 8.5% of the offering price. Offering price. In order for a fund to do this, as we've discussed previously, the fund must have a schedule of breakpoints. So breakpoints are for large lump sum purchases where they get reduced sales charges. The fund must also offer the right of accumulation, and the fund must allow the automatic reinvestment of income distributions at net asset value. So that's without a sales charge. So these are the three things that a mutual fund must do in order to charge this maximum sales charge, 8.5% of the offering price. Now, most funds don't charge this, but this is what they could charge. So of course, we have to know what they could charge. The quantity discount and or the right of accumulation that the fund offers must be at least as good as what I'm going to describe next. Of course, it can always be better than what I'm going to describe. It just must be at least as good as what I'm going to describe. If the fund has the right of accumulation, but not in the manner in which I'm going to describe in a moment, so if the features aren't as good, then the maximum sales charge that they can charge will fall to only be 8%. So the maximum sales charge allowed, if this right of accumulation does not meet or exceed what I'm going to do next, then it falls down to 8. Quantity discounts, if the fund offers them, shall be made on single purchases by any person in accordance with one of the following two alternatives. So the quantity discounts have to be set up like this, and then the right of accumulation. So remember, think about it. Not everybody has big lump sums to put in all at once into a mutual fund. Most people put in $100 a month, and then eventually they get over a break point. So if the fund has the right of accumulation and they don't at least meet this rule, then the maximum sales charge they can charge is 8%. So either way would be fine, or better than would be fine. The maximum aggregate sales charge of 7.75% on purchases of $10,000 or more So there's two alternative schedules that they can set up for the quantity discounts. Maximum aggregate sales charge of 6.25 on purchases of $25,000 or more. So really these are breakpoints, right? Quantity discounts. If the fund offers the right of accumulation, it must meet one of these two things if they want to charge the maximum 8.5%. The maximum aggregate sales charge of 7.5 on purchases of $15,000 or more. So this is a higher threshold and 6.25 on purchases of $25,000 or more. So this is the same in either one of these. So schedule of breakpoints. Obviously, let's say they followed this one, just for example, and I was going to be putting in $20,000. What's the maximum sales charge they could charge me? 7.25. But let's say I'm not putting that much money in all at once, but instead the fund offers the right of accumulation. And the purchase that I'm making right now gets me over the $15,000, gets me to $15,000 or more. So my sales charge could have been, for the first many investments, right, up to this point, 8.5. But now that the money I'm investing gets me to the $15,000 or more, now it's 7.25. So it goes down. But I have to accumulate the balance over time. If the schedule of breakpoints does not meet one of these, is not as favorable or better than one of these, then the maximum sales charge that they can charge me is 8%. So we know the 8.5% sales charge when it's allowed, no 12B1 fee, no service fee. But if the fund has a right of accumulation that's not as good as what we discussed for the quantity discounts, then the maximum sales charge that they can charge is only 8%. Another rule that the test definitely wants you to know, if the fund has a service fee. So the service fee is the account maintenance fee, but no asset-based sales charge, which is a 12B1 fee, but no 12B1 fee, then the maximum sales charge allowed is 7.25%. But what if it has all three? So if the fund has a 12B1 fee, that's the asset-based sales charge, and a service fee, and load, could be front load or contingent deferred sales charge. So if it has all three of these things, then the maximum sales charge that can be charged is 6.25%. Now, this one can go either way. So here we said the fund has a service fee but no 12B1 fee. The maximum sales charge is 7.25. The opposite would also be true. If the fund has a 12B1 fee but no service fee, the maximum sales charge allowed is also 7.25%. So either one of those gets you into the 7.25% rule. And remember, the sales charge, whether or not it's a front load or a contingent deferred sales charge, which is a back end load, nobody cares. It doesn't matter. The same rules apply. Now, there's a maximum as to what the 12B1 fee can be under NASD Rule 2830. So 12B1 fees, for the purposes of FINRA and NASD rules, are called asset-based sales charges. They're used for the distribution and sales expenses related to the shares. So 12B1 fee and asset-based sales charge is the same thing. I really like the asset-based sales charge name better. It's more descriptive in my humble opinion. So the most it can be is 0.75%. So less than 1%. So I'm not saying 75%. It's 0.75%. So less than 1. Of the average annual net assets of the company. This is the maximum that it can be. 0.75 of 1%. Because I know sometimes that confuses students, and I'm trying not to confuse you. That's my goal. So 0.75 of 1% of net assets. That's the most it can be. If the fund wants to call itself a no load, which a lot of times funds want to do, then the maximum 12B1 fee is 0.25 of 1%. So 1/4 of 1% of net assets. If they want to call themselves a no load, that's the most the asset-based sales charge can be, 0.25 of 1%. So if it's more than that, it can be up to 0.75 of 1%. They can't call themselves a no load. If it's 0.25 or less of 1%, then they can still call themselves, in their prospectus, in their marketing material, they can still call themselves a no load fund. So I would definitely know those rules for sure. Now, mutual funds may pay dividends at most quarterly. You should never encourage that someone buys a mutual fund share right before the ex-dividend date. When you buy before the ex-dividend date, you get the dividend, yay, but maybe not, because you get something that's taxable to you. So in fact, it's better to wait until after it goes ex-dividend. You'll end up paying less. So no selling dividends, NASD Rule 2830 warns you. You should never withhold placing customer orders from any investment company so as to profit from such withholding. That just seems bad. There's also within this rule a rule regarding refund of sales charges. Anytime a security issued by an open-end management company is tendered for redemption within 7 business days after the date of the transaction, the dealer, broker, and underwriter all have to refund their sales charges to the issuer. So if you got paid a commission for sale of mutual fund company B's shares, but your client tendered those shares for redemption in the first 7 business days after they bought them, you don't get a commission on that. You have to give it back to the issuer. Dealer concessions. No member who is an underwriter of the securities of an investment company shall sell any such security to any dealer or broker at any price other than the public offering price. So no discounts, just when you sell open-end shares, you sell them at the offering price, the ask price, the public offering price. This rule also discusses compensation. In connection with the sale and distribution of investment company securities, except as I'm going to describe in a minute, no associated person of a member shall accept any compensation from anyone other than the member with which they are associated. So if I'm a registered rep for broker dealer ABC, that's who pays me, not investment company Z. I get paid from my broker dealer. This rule, however, does not prohibit arrangements where a non-member company pays compensation directly to associated persons, that's me in that story, so long as the arrangement is agreed by the member relies on an appropriate rule, regulation, interpretive release, interpretive letter, or no action letter issued by the commission or its staff that applies to the specific fact situation of the arrangement. The receipt by associated persons of such compensation is treated as compensation received by the member for purposes of the rules of the association, and the record-keeping requirements are satisfied. When I am a registered rep working for a broker-dealer, no member or person associated with a member shall accept any compensation from an offerer, which is in the form of securities of any kind. So the investment company can't say, every time I recommend and somebody purchases a mutual fund share, they'll give me a mutual fund share. No way. That's prohibited. Members are required to maintain records of all compensation received by the member or its associated persons from offerers. The record shall include the name of the offerers, the names of the associated person, the amount of the cash, the nature, and if known, the value of non-cash compensation received. So this is where we go back to those few definitions that I discussed at the beginning of this rule, why we needed to know the offerer really is a fancy way of saying investment company. Cash is cash, and non-cash are things that are not cash, gifts, travel expenses, lodging, those sorts of things. No member shall accept any cash compensation from an offerer unless such compensation is described in a current prospectus of the investment company. When special cash compensation arrangements are made available by an offerer to a member, which such arrangements are not made available on the same terms to all members who distribute the investment company's securities of the offerer, a member shall not enter into such arrangement unless the name of the member and the details of the arrangements are disclosed in the prospectus. So this is basically saying if my broker-dealer receives a higher commission than the investment company pays to another broker-dealer to sell the same shares, in order for that to be legal, it must be disclosed, must be described in the prospectus. No member or person associated with a member shall directly or indirectly accept or make payments or offers of payments of any non-cash compensation. So really the rule is non-cash compensation is prohibited, except as provided by the rule. There's always an except. Isn't that how all of these things work? So the following non-cash compensation arrangements are okay. Gifts that do not exceed an annual amount per person per year that's fixed periodically by FINRA and are not preconditioned on achievement of a sales target. So this idea of allowable, generally speaking, non-cash compensation is not allowed, but what is okay? Gifts can be made from a mutual fund company to me, the registered rep, of a certain value. So currently it's up to $100 per person per year. Per person per year. So they're going to say things like, they made a gift of season hockey tickets to you. Is that allowed? No. They gave you 2 concert tickets. The face value of each ticket was, let's say, $45. Is that okay? Yes. 45 times 2, $90, that'd be okay. What if they paid $110 a ticket on StubHub? Still okay. Use the face value of the ticket. The test tries to trick you. So the current amount is $100 per person per year. That's okay. An occasional meal. They can sometimes feed you. An occasional ticket to an event or the theater. So long as it is not so frequent nor so extensive as to raise any question of propriety and is not preconditioned on the achievement of a sales target. So could they give me an iPad? No, they're more than $100 still. So they can't do that. They can give me those tickets. We talked about the tickets rule. They can feed me sometimes as long as they don't say, I'll take you to lunch once you surpass 10,000 shares for our company that you've sold. No, just take me to lunch and hopefully I'll sell more of your mutual fund shares. What else is allowed? Payment or reimbursement can be made by offerers, so mutual fund companies, in connection with meetings held by the investment company or by a member for the purpose of training or education of associated persons of a member, so long as the record-keeping requirement is satisfied, so long as associated persons obtain the member's prior approval to attend the meeting and attendance by the member's associated persons is not preconditioned by the member on achievement of a sales target or any other incentive pursuant to a non-cash compensation arrangement. So they can pay that I go to a meeting if the meeting's for training. The location needs to be appropriate for the purposes of the meeting. So if I live in Arizona, the meeting can't be in Hawaii. I mean, seriously, I'd love to go to Hawaii, but that would not be an appropriate location. So location in the vicinity, a regional office would be okay if it was a regional meeting, but Hawaii is a long ways from Arizona. Payment or reimbursement can be made by the investment company to a registered rep for going to a meeting, but they can never pay for the expense of a guest of an associated person. They cannot. It's non-allowable, non-cash compensation. So they can pay for me to go to the meeting, and that would be fine. The payment or reimbursement by the offeror cannot be preconditioned by the offeror on the achievement of a sales target or any other non-cash compensation arrangement. So, can't ever be, cannot ever be. What else is permitted? Another non-cash compensation arrangement that is permitted. Non-cash compensation arrangements between a member and its associated person, or a non-member company and its sales personnel who are associated persons of the affiliated member, provided that the members or non-members' non-cash compensation arrangement, if it includes investment company securities, is based on the total production of associated persons with respect to all investment company securities distributed by the member. So what this is basically saying, and this rule we'll see again when we talk about FINRA Rule 2320. These are sales contest rules. I told you that this was going to get eventually to sales contest rules. So can your firm have a sales contest? The basic answer is yes, if the rules are followed. So can they have a sales contest for the sale of mutual fund shares, for the sale of variable annuities, variable life also would be fine. Yes, if the rules are followed. So NASD Rule 2830, and then the variable products rule is a FINRA Rule 2320. Total production of associated persons with respect to all investment company securities distributed by the member. So first we've got total production. So basically what this is saying is that if we're going to have a contest as to the sale of mutual fund shares, or same rules going to apply here for variable annuities. And very commonly broker-dealers represent more than one investment company. And very often they have their own investment company proprietary fund, if you will. The sales contest can't be for their proprietary fund only. If it is, they're going to get in big trouble. Firms get in big trouble when they do this. They've done this and gotten in big trouble historically for this. So the sales contest has to meet total production. So most investment company securities sold of the things that we can offer, not just related to one company. The non-cash compensation arrangement requires that the credit received for each investment company security is equally weighted. Once again, this whole rule is designed to make sure that the broker-dealer is not giving you more points for funding, for encouraging your customers to buy the proprietary fund. So it's not 1 point for all the other funds that you sell and 3 points if you keep the money within the proprietary fund. That would be prohibited. No unaffiliated non-member company or other unaffiliated member directly or indirectly can participate in the members or non-members organization of a permissible non-cash compensation arrangement, and the record-keeping requirements must be satisfied. So broker-dealers can have sales contests, so long as it's an overall contest. Who can sell the most variable annuities and variable life insurance? Equal weighting is given. So it is okay if those rules are followed. So in a nutshell, NASD Rule 2830 is in regards to sales charges for investment company securities. So we talked about the 8.5, the 8, the 7.25, the 6.25. Those are the big ones for sure to know. It also talks about non-cash compensation arrangements, no gifts of more than $100, make sure you remember that. There's going to be some sort of season tickets to the theater, which of course would be prohibited. And this idea that sales contests are allowed if these specific rules are followed. And then we will sometime later on in the course see the rule as it relates to variable products of insurance companies. That concludes our discussion for NASD and FINRA rules. Remember, read your key facts 3 or more times, practice your section quiz. I want you to get to the 90% or better, and then there is a Critical Function 1 final exam. So you get to do that before you get to move on to Critical Function number 2. Have fun.